The term IPO refers to an initial public offering. An IPO occurs when a privately held company lists its shares on a stock exchange, allowing the general public to purchase them. Sounds simple, right? It's a little more to it than that, so hit the subscribe button and let me explain. Many people think of IPOs as big money-making opportunities. When high-profile companies go public, they make headlines with massive share price gains. While IPOs are undeniably trendy, you should be aware that they are extremely risky investments with inconsistent long-term returns. How does an initial public offering work? Going public is a difficult, time-consuming process that most businesses find difficult to navigate on their own. A private company planning an IPO must not only prepare for an increase in public scrutiny, but also file a slew of paperwork and financial disclosures to satisfy the Securities and Exchange Commission, SEC, which regulates public companies. That is why a private company that intends to go public hires an underwriter, usually an investment bank, to advise on the IPO and assist in determining the initial offering price. Underwriters assist management in preparing for an IPO by creating key documents for investors and scheduling roadshow meetings with potential investors. Once the company and its advisors have agreed on an IPO price, the underwriter distributes shares to investors and the company's stock begins trading on a public stock exchange, such as the New York Stock Exchange, NYSE, or the NASDAQ. Why do companies issue initial public offerings? An initial public offering, IPO, may be the first time the general public can buy shares in a company, but it's important to understand that one of the purposes of an IPO is to allow early investors in the company to cash out their investments. Consider an IPO to be the end of one stage in a company's life cycle and the start of another. Many of the original investors want to sell their stakes in a new venture or startup. Alternatively, investors in more established private companies that go public may want to sell some or all of their shares. Other reasons for a company to pursue an IPO include raising capital or increasing a company's public profile. Companies can raise additional funds by selling stock to the general public. The proceeds could be used to expand the business, fund R&D, or pay off debt. Other methods of raising capital, such as venture capitalists, private investors, or bank loans, may be prohibitively expensive. Going public through an IPO can provide companies with a lot of publicity. Companies may desire the standing and gravitas that come with being a publicly traded company, which may also help them secure better terms from lenders. While going public may make it easier or less expensive for a company to raise capital, it complicates a slew of other issues. Disclosure requirements include filing quarterly and annual financial reports. They must answer to shareholders, and there are reporting requirements for actions such as stock trading by senior executives or other transactions such as selling assets or considering acquisitions. Important IPO terms. Initial public offerings, like everything else in the world of investing, have their own jargon. You should be familiar with the following key IPO terms: shares of common stock. Units of ownership in a public company that typically entitle holders to vote on company matters and receive dividends from the company. When a company goes public, it sells shares of common stock. Price of issuance. The price at which an IPO company's common stock will be sold to investors before it begins trading on public exchanges. Known colloquially as the asking price. Size of the lot. The smallest number of shares available for purchase in an IPO. You must bid in multiples of the lot size if you want to buy more shares. Prospectus Preliminary. The IPO company's document that discloses information about its business, strategy, historical financial statements, recent financial results, and management. It is sometimes referred to as the red herring, because it has red lettering down the left side of the front cover. Price range. The price range for IPO shares set by the company and the underwriter. It differs depending on the type of investor. Qualified institutional buyers, for example, may have a different price range than retail investors like you, underwriter, the investment bank in charge of managing the offering on behalf of the issuing company. In general, the underwriter determines the issue price, publicizes the IPO, and assigns shares to investors. SPACs and initial public offerings. The rise of the Special Purpose Acquisition Company, SPAC, also known as a blank check company, has occurred in recent years. A SPAC is a company that raises funds through an initial public offering solely for the purpose of acquiring other companies. Many well-known Wall Street investors use their established reputations to form SPACs, raise capital, and acquire businesses. People who invest in a SPAC, on the other hand, aren't always told which companies the blank check company intends to buy. Some disclose their intention to pursue specific types of companies, while others keep their investors completely in the dark. It's giving your money to an entity that doesn't own anything but tells you, "Trust me, I'll only make good acquisitions with it," says George Gagliardi, a certified financial planner in Lexington, Massachusetts. You don't know what's coming at you, like a baseball batter wearing a blindfold. Many private companies choose to be acquired by SPACs in order to accelerate their public market entry. SPACs do not have long financial histories to disclose to the SEC because they are newly formed companies. Furthermore, many SPAC investors can recoup their entire investment if a SPAC does not acquire a company within 24 months. How to buy IPO stock? Buying stock in an IPO isn't as simple as just putting in your order for a certain number of shares. You'll have to work with a brokerage that handles IPO orders. Not all of them do. Typically, you'd have to buy IPO stock through your stockbroker, and on rare occasions, directly from the underwriter, i.e., knowing someone at the company or investment bank, says Gregory Sacenzia, founding partner of Sacenzia Ross Ference, a New York City-based securities law firm. Brokers like TD Ameritrade, Fidelity, Charles Schwab and E-Trade may offer access to IPOs. At many firms, though, you'll also need to meet certain eligibility requirements, such as a minimum account value or a certain number of trades transacted within a certain time frame. Perhaps most importantly, even if your broker offers access and you're eligible, you still might not be able to purchase the shares at the initial offering price. Everyday retail investors generally aren't able to scoop up shares the instant an IPO stock starts trading, and by the time you can buy, the price may be astronomically higher than the listed price. That means you may end up purchasing a stock for $50 a share that opened at $25, missing out on substantial early market gains. To help combat this, platforms like Robinhood and Sophie now enable retail investors to access certain IPO company shares at the initial offering price. You'll still want to do your research before investing in a company at its IPO. Should you invest in IPOs? As with any type of investing, putting your money into an IPO carries risks, and there are arguably more risks with IPOs than buying the shares of established public companies. That's because there's less data available for private companies, so investors are making decisions with more unknown variables. Despite all the stories you've read about people making bundles of money on IPOs, there are many more that go the other way. In fact, more than 60% of IPOs between 1975 and 2011 saw negative absolute returns after 5 years. Take Lyft, the ride-share competitor to Uber. Lyft went public in March 2019 at $78.29 per share. The stock price dropped immediately, and within a year, it reached a low around $21. The stock price has recovered somewhat, and as of writing, the price was above $57. But even if you had bought in when Lyft went public, you still wouldn't have recouped your investment. Just because a company goes public doesn't mean it's a good long-term investment, Chansey says. Take, for example, Y2K's most infamous victim, Pets.com, which went public at around $11 per share, only to see its price plummet to 19 cents in less than 10 months due to massive overvaluation, high operating costs, and the dot-com market crash. Let us know down in the comments if you found any value in this video, like the video and subscribe to our channel.